do. Am I coming through okay on sound, Seth?
You sound good to me. Hopefully my
Oh,
sound.
I bet I always
Welcome,
sound good
everyone,
here.
to Name Confidential Live.
Hey guys, welcome back. I'm Branden DuCharme, one of your hosts here at NAAIM. And today I'm joined by a colleague, Seth Cogswell from Running Out Capital. This guy, let me tell you, he does not random walk. Seth runs, my friends. Runs Running Oak. The name exposure index this week posted at 83.69, which is showing that active managers, as a demographic from a sentiment perspective, are actually backing off a little bit on this market. And that's kind of the conversation that I want to have a little bit with Seth today, is this conversation around the idea of like, how much does valuation and macro forces really play in the market when there's, some people say that there's this passive investing markets just go up, hold on, it goes up over time. However, like valuations are once again like pretty stretched. And I think a lot of data, Seth, is showing that valuations are actually near the same kind of peaks that they were towards the end of 2021. That gets to be a little bit dicey, right? Like you start to wonder here, how much further can a market even go? And so how does somebody start, navigating this or thinking about this? And you are someone that has an interesting background. What's your take on sort of the nature of valuation and this kind of interesting market environment we're in right now?
A constant mantra of mine is that everybody's heard is the market can be irrational longer than you can be solvent. Luckily for us, we are a long only manager, so I don't have to worry about solvency. But the irrational part is definitely accurate. In the past, when I was a trader and then managed technically a hedge fund, I was far more active, and that mantra had to be recited on a daily basis, so I didn't do anything really dumb. Today, I don't have to worry about that. It's more as an observer. Um, you know, Really, valuations have been stretched for a long time. We've had kind of some dips and whatnot, but for the most part, by and large, they've been quite stretched historically. And the thing is, valuations just don't really matter until they do. I also like the phrase that which can't last forever doesn't. Uh, I think that valuations will matter because it's numbers.
Yeah.
But uh, let's use another quote. The was it Warren Buffett that said um, the what is it? I'm going to completely mess this up. But basically, emotions, it's like a weighing game versus I should have come prepared with that quote. Regardless, I love it. So look it up. There's a
I,
Buffett quote talking about how, emotions, how much of a role emotions play in terms of valuations. And we're just very much seeing that right now.
yeah.
Uh, we're years into every single time the market goes down, it flies right back up. And we all have recency bias. And so we've all sort of been trained to believe that the market does nothing but go straight up. And if that's the case, risk and numbers just simply don't factor into most people's considerations.
Well, there's an old saying I always remember, right? Which is everything's funny when you're making money, but it ain't no joke when you're broke.
Love that.
Right. I think that's kind of the way valuation works, right? Like everything's funny when you're making money. It feels like the PE multiple tree can grow to the sky. That there's no limit to the expansion. And it's typically around that point where uh, it starts to really matter, and things can come unwound, quite quickly. I think the Warren Buffett quote is, you only see who's swimming naked when the tide goes out, right?
That's
And
a
that's
good
when
one.
things aren't so funny, right? So some people they might be, but nonetheless. Uh, so personally, like I've had some conversations lately where I've looked at stuff, and I do a fair amount with my client base personally, talking about real estate, and their real estate holdings outside of the securities market, right? And this concept of like valuation, and I think what's interesting is real estate is one of these asset classes that valuation, and particularly fundamental analysis and valuation, really still matters quite significantly, and is a lot harder to distort for a significant amount of time in terms of valuation, right? And I think we're finding that real estate is sort of at that place, particularly just residential real estate. Um, but where else do you look, right? Because all of a sudden you kind of see like everything has quite a bit of risk, where we're at, and I think one of the interesting things is this idea of everything's funny when you're making money. We do a good job of, oh man, it's going up, so let's hold on, and now we can just be complacent because it's going to grow to the sky. Like what does somebody turn to at this point? What are the options, and how can they look at things differently?
One of the concepts that I've been noodling a little bit lately, it's very simple. Maybe that's why nobody talks about it, is inherently it. I mean,
Yeah,
it sort of
yeah,
sounds dumb on the surface, but it's the idea of investing where others aren't. Simple concept, but if you are investing in the same things that everybody else is piling into and has been piling into for years, it's just natural that demand is going to drive those prices up, which means you're going to be paying higher valuations. And that means that your implied return is lower and you have more downside risk. So higher risk, lower return. That's the exact opposite of what we are all seeking to provide clients. On the other hand, if you invest where others aren't, the less popular options, which there's plenty of great ones out there, uh, then you don't have that supply and demand dynamic that's really driving prices up. You get lower prices, lower valuations, which implies higher potential returns and a margin of safety to the downside. And that's what we're all looking to provide, right? To take less risk to provide higher return. Right now, there's there's just so much money somewhat indiscriminately chasing a small number of companies. I think last I saw now, maybe the 10 largest holdings in the S&P are almost 40% of the index. Um, and yes, those are great companies. They are delivering uh, significant growth, but the problem is you're also seeing those multiples expand, right? So it's one thing if a company's delivering significant growth and grows into those multiples. It's another thing if you're really seeing those multiples expand and people are paying more and more of a premium. And the problem is so much money is investing in those somewhat indiscriminately, right? Whether it's 401k allocations that are just going right in there, or people being more excited to invest in Microsoft or Tesla versus some, upper mid cap industrial company. Um, it adds risk. And there was actually an article today uh, that cited it was Apollo and BTIG, and the forward P of the top 10 holdings in the S&P is now significantly higher than the forward multiple of the top 10 holdings in the S&P during the tech bubble. Um, that's concerning, right? We're talking all about valuations, and the thing is, they don't matter until they do, right? Like as long as things continue and there's no sort of come to reality moment, then it can continue. But all it takes is a tiny hiccup and things can change very rapidly. And that's where a margin of safety comes in, right? There are options out there. You just have to look off the beaten path, I guess, a little bit.
yeah. I mean, in your research, do you think you find like Is there a segment of the market that seems to be providing that is somewhat undiscovered, or do you have to get super deep and niche into, small and micro cap companies, like, or get way off the beaten path into unique crypto projects, or, like, uh, metals or commodities? Like, how far does somebody need to wander to start, like finding this essence of value when, according to a lot of the metrics, when you gauge, I'm going to use air quotes here, like the market is really, really top end heavy on valuation.
I would say that it might actually just be staring you right in the face. Those, at least some options
Hmm.
that are more attractively valued that are less hot, I guess. Um, you know, the market has evolved in a way where supposedly over 50% of equity assets are now in passive, right? So that, which basically passive is a synonym of thoughtless, which isn't to say that passive hasn't provided significant benefit, but it's just there's no thought going into how
Yeah.
that capital is allocated. And not only that, but it's also evolved into sort of an ETF or kind of a basket market where not only do you have these passive investments, but you also have, you can easily just invest in sort of a basket of stocks. And and so you've got money kind of going into these certain things that are moving those, and there's now probably the least number of people or assets going into, certainly percentage wise, seeking out these attractive investments. That in over the last 2 years, as I've gotten a much clearer sense with how the biggest allocators are investing, and I see this, across advisors as well. Most seem to be building portfolios in pretty much the same way. You start out with large cap growth because that's where the big names are, right? If you didn't have significant large cap growth exposure over the last decade, you probably don't have a job anymore. So you got to start out there, and then you complement it when you're building out a diversified portfolio. You complement that usually with maybe a SMID portfolio. Very few are using mid and small. So let's say SMID, and then value. And the problem is a lot of these large cap portfolios that people are investing in and thinking they're getting significant diversification, they are, they're paralleling basically the S&P, right? Everybody talks about the concentration risk in the S&P, but it's the same in a lot of these large cap diversified portfolios, and most people don't realize it because it's not getting
Yeah.
people aren't talking about it as much as they are with the S&P. And so I use SCHG as an example only because I see it a lot. That is a portfolio that many invest in thinking they're getting this diversified large cap growth exposure. But recently, 60% of SCHG was invested in 8 companies, only 8.
Yeah.
That's not much diversification. And that leaves 40% all the way through the rest of large cap growth as well as into core, because most people also aren't really singling out core. And then if you're complementing that with SMID, which walks the line between small and mid, you don't get as much concentration on the upper end of mid either. So a lot of, I'd say most portfolios that I see have very little exposure from the middle of mid cap all the way up to above the middle of large cap. It's a huge gap. So as you mentioned, we used to think, you got to go to micro cap maybe to find like these unhidden, I mean, these like hidden gems or something. But or these undiscovered companies, right now there's so little money going into the middle of the market, right? So upper mid, lower large cap, big companies, there there's very little being allocated there. And so it's funny. It's one of those moments where uh, there's just with the dynamics, there's so much money going in certain places, and then there's a spot right in the center of most people's portfolios that's getting nothing or very little.
Is that sort of like you're describing almost like a barbell approach people have had to portfolios, which is, hey, have the large caps because you have to manage it. And I don't think you actually have to. I just think people do it be out of their own self-interest, manage the tracking error, right? from S&P 500 or whatever it is. So you got to load up the portfolio with a certain amount of, you know, tracking error hedging really is what it comes down to. And then from there you say, okay, well, where has, performance been generated the most from? Because if I'm going to try to outperform, I now have to, take my other ideas and look for the things that are hopefully going to outperform in a meaningful way. And so you have this like, oh, well, the traditional thought, right? Small cap value is this factor that, should perform a lot of outperformance and, maybe tilting international, whatever it might be. Obviously, in hindsight, we know that both of those things have wildly underperformed, the large cap, US large cap, last number of years until on international, the last 6 months. And I'd say since April, US is once again outperforming in a pretty meaningful way, right? That's mean reverting, I think, in nature right now. But there's so this barbell approach, right? I have to have the hedge against tracking error. So I have this large cap trade on that everyone else is in. I'm going to get in the same crowded trade, and then I'll go to small cap value. And so what they miss in between is this mid cap sort of area of opportunity that you think is worth looking at.
First of all, I feel my blood pressure spike every time I hear the two words tracking error. I feel like those might be my two most hated words. Um, as
How-
a recovering perfectionist, I have a hard time being okay with being average. It just doesn't work for me. I can't accept it. And tracking error, if you outperform, it creates tracking error. And if you have significantly less downside, that creates tracking error too. So you literally, the things that we all want, I mean, literally, like the two important things that we all would say we want, higher returns, lower risk, creates tracking error. And yet it's seen as like a really, a bad word. It's crazy. That blows my mind. But regardless,
yeah, tracking error can be a good thing, right?
it is a good thing. Well, it can be a good or bad, right?
Right. No, it
It
can
can
be a
be good
good
or bad.
thing. Um,
That
it
drives me
depends.
nuts, though.
Well, it's just like beta in a portfolio. Beta can be a good thing or a bad thing, right? Any of these things can be good or bad.
Sure.
Um, but again, it's actually like what I found it to be is that it's almost like the media it has done such a good job at training the retail audience or the people that tend to be, clients, whether they're honestly, whether they're retail or institutional, it's like, well, how are we doing against this benchmark? We need to
Yeah.
look at the benchmark. And I've always found that a little bit interesting because you're looking at an arbitrary, index return benchmark, in which case most years you probably wouldn't be super happy with the results, right? In those drastic down years, right? But you still use it as the benchmark in the up years is like behaviorally what I found because they forget, like people forget, right? So like everyone remembers the pain of '08, but
Or do they?
in an up year, right? In an
It
up year,
doesn't-
people are kind of trying to say, well, I turn on the news and it says the market's up 8%. Why am I up 6? Or why am I, you know what I mean? And it's one of those businesses where you get a little bit of, you might get a little pat on the back if you say, what do we're up 9, great, Um, but if you say we're up 6, and it's like, well, I could have bought the index, what are we doing here?
Yep.
I could have bought that passive fund, been low cost. What am I paying for here? And the problem people always forget is the old saying, right? Your largest drawdown is always ahead of you. And so if you're invested in S&P 500 and there was a historical, drawdown of 54% in '08, are you okay with the larger than that drawdown at some point in the future? And what I find is that most people's investment mandates wouldn't include such risk capacity. It's just what I've observed, but I'm sure there's some people out there that just love and are okay with losing money and doubling down, and the old martingales of the world, good for them. But it is certainly an interesting phenomenon.
Yeah, there's a lot to unpack there, but I think I mean it wasn't that long ago where one of the indexes that everybody was using was the Dow Jones, right? And that was this small number of companies that for some reason, even not that long ago, people were using as a benchmark, which was weird. I do think also going back to your small cap comment, because it actually kind of touches on tracking error. We have to be careful. We hear about certain things all the time, and then it's easy to just sort of take it for granted, accept what we're told. So again,
Hmm.
whether it's tracking error, that's a gray area, right? If you do well, you're going to have tracking error, right? If you
Hmm.
deliver higher return, low risk, you're going to have tracking error. So be careful of that sort of weird conventional wisdom of trying to minimize that. It's the same with small cap. At some point, I got to go back and look at the data that led Fama French to conclude that small cap value was the place to be in the market because, first of all, it just doesn't make a whole lot of sense to me as far as kind of common sense. The idea that the market will magically pay you because you're taking on liquidity risk just doesn't, I mean, I don't know that the market magically pays anyone anything. But what we've seen over the last 33 years is that mid cap has outperformed large by over 60 basis points annualized over the last 33 years. So if you aggregate that, that's more than a 20% in aggregate return. And it's smoked small cap. Small cap's not even close. And keep in mind that, that outperformance of large includes the last decade where large has destroyed everything.
Hmm.
Um, and not only that, uh, mid cap is kind of where you get that potentially, at least again, sort of, let's say philosophically, and also today just because of the lower valuations. But philosophically, that's where you get that risk return asymmetry, which we're all looking for, right? We want to take as little risk to get as high a return as possible. Mid cap, because it's larger than small, mid cap companies have kind of graduated from small. They've had some significant success. Larger companies, there's more liquidity, so it's going to be less liquid or less risky than small cap in general. But then from a size standpoint, as you get bigger and bigger, generally speaking, there are some network effects, but generally speaking, the bigger a company is, the bigger let's say the bigger their earnings number is, the harder it is to grow that in multiples, right? So like let's say mid cap, a company graduated from small to mid because they just nailed a product. All it takes is one more product, right? Maybe they double. Whereas for Apple, let's say, that's very hard to do. It's hard to imagine Apple doubling.
Hmm.
Um, and so mid is this space that for some reason is both completely ignored by conventional wisdom, right? So we've got the tracking error argument, which drives people into large cap growth. You've got the small cap value. I almost think it's a myth at this point. Again, I need to go back and look at the data that's driving people to that. And it is a barbell approach. And it just so happens the bar is right where the last 33 years and just common sense would tell you to at least invest a decent amount.
Yeah. Well, it sounds like in the mid space, in order to kind of capture the vision of it, you almost have to, you have to be willing to say like, well, I guess you really wouldn't have to because you could, sliding it into the portfolio in any amount is always going to sort of even out the ends. But it's big enough that I don't know what the tracking, like, again, I don't know what the tracking error looks like, not to go back to this tracking error conversation, right? But like,
I think you're just messing with me at this point. I
well,
tell you that
tracking error,
that
tracking
term
error,
drives
tracking
me
error.
nuts, and you just keep repeating it.
Well, it's one of those things. It's like, so are you giving up a lot of, are you losing something by not having the large cap, that crowded large cap trade? And are you losing something by not having exposure to the small cap value? And I guess really what I'm saying is that you don't necessarily have to pick either or, right? That's the beauty of portfolios and ETFs these days is like, it's pretty easy to get exposure to whatever you want in whatever allocation in a pretty reasonable and cost effective way, right? More so than it certainly was 30 years ago.
Yep.
Um,
There's definitely a give and take, right? You're taking from something to invest in something else, right? So if you're going to invest in it, you got to pull from somewhere. Um, but I would say this today feels
I mean,
unbelievably uncertain to me. I'm not especially comfortable in where we're headed. I don't know what's going on, and when things are uncertain, that's where diversification is probably the most important because you don't know. Well, I have no idea how this is going to play out, right? Like maybe large cap growth, these big tech names just keep going. There's certainly plenty that's in their favor.
It's
Uh,
certainly an interesting phenomenon that I've thought about personally as I've tried to chew on this whole thing, right? Of like, oh, it's hard to, like, to use your example, right? It's hard to imagine Apple doubling in size. However, if Apple can buy every single one of their competitors out of the small cap space like it's nothing, then all of a sudden Apple does double in size because Apple's not really Apple. Apple's a conglomerate of what was 4,000 different companies, right? Right? Like, and their access to cheap capital because people are, they could theoretically issue shares at these incredibly rich valuations. And when rates were low, they issued a ton of. I still am trying to figure out like who bought the app, like the 40-year bonds issued by like Amazon and Apple that were like I think they were like 2% paper or something. I
They're
don't
regretting
know.
that one.
Like yeah, I don't know why somebody would buy those, but they did. And good for those large cap companies that were able to issue it at that. But like that has given actually them such an interesting fundamental advantage that, and I'm just playing, like Mr. Contrarian here is like, does that actually answer the question of why is there this large outperformance? And maybe it is somewhat like, maybe it's not entirely rational, but it's more rational than maybe you or I are initially giving it credit for right now. I
Yeah.
don't know.
Yeah, I mean, there's so many different factors that have favored the big techs. So it's it's not entirely irrational or unjustified by any means. Um, but again, the forward PE of those top 10 um, apparently now is quite a bit higher than the forward PE of the top 10 during the tech bubble. So it's definitely something to think about, right? I mean, it's just managing money, whether it's, I'd say particularly being an advisor, because I don't interact as much with individuals. But being an advisor and having to manage the psychological aspects of, um, I don't know, money in general
Yeah.
is so challenging, right? I mean, what really matters, if we always talk about risk and return, but if you think about it in kind of simpler terms, I mean, return is hopefully the ability to help somebody grow. People work all day, every day, right? Let's say 8 or 9 hours a day, 5 days a week,
Mhm.
52, well, we'll say 50 weeks a year. Hopefully they take a vacation for I don't know how many years, many of whom are doing jobs that they probably don't even like, right? And they're trying to save up a certain amount of money so that someday they can either provide their families the lives that they want or they can retire. And that is what we are trying to help people with, right? And when we oversimplify it to just buy spies and close your eyes, for me, it just doesn't do justice to how much work and how much they've like worked to accumulate this money and how much it means to their lives, right? So
Yeah.
return is the growth of that. Is like, does it help them achieve what they want? But risk, maybe even more importantly, we talk about risk and there's different definitions, but most importantly, I'd say it's just one, is the money going to be there when they need it? And can they sleep at night? And that's, and people are completely overlooking that aspect that's just sort of overhanging, right? Like again, market's gone straight up for like 10 years, so people aren't thinking about it. But it's a real thing, right? The market, we've had lost decades, we've had significant declines, and people have such a massive percentage of their net worth that they've worked so hard for in a tiny number of things. And maybe they continue to work out, fine, right? If they do, great. But if you see what you've worked so hard to achieve kind of evaporate, I mean, that would be devastating. And I think that the odds of that are much higher than people
Yeah.
are considering.
Yeah. I hate to wrap it up on this note, but I have had this thought come across my mind several times, and it is not one that I care to pander out there very much, right? I'm not the guy that tends to draw a lot of comparisons between market cycles. But I have heard people say to me like, well, NVIDIA is and I'm going to call out the NVIDIA because it's particularly the largest right now. Like I have no other opinion on NVIDIA. It's the example here because it's the largest. NVIDIA is so big and it's such an important company. It will be around forever, no matter what. And thus in their head, when I hear people say that, they're describing to me in their words that it is a safe and rational investment to be very heavily allocated or all in on such a company. And I can't help myself but thinking, well, Cisco is also still around. You have not had a meeting. You still have not broken even, right? If you were investing into Cisco at the peak and kind of the dot-com era, right? So yes, companies can exist, but that doesn't mean stock prices, right? So I call that out to really say like, look, as investors, I think we should always, whether it's our investment style or not, as portfolio managers or allocators or individual investors, right? There is something to be said about the company is not and I think Jeff Bezos is the one that really called this out actually on Amazon stock. The stock is not the company and the company is not the stock, you know? And so I think giving some credence to that and saying, what is it? What is my game plan here? You know, and if your game plan's a momentum investor, enjoy the ride, you know, like maybe it goes on for quite some time. Maybe it doesn't. I have no idea. I just
You're
think,
surfing a wave.
yeah, I think it was Yoda that once said, invest you must, reckless you must not be.
I don't recall that,
You
but
know, I think it was in there.
yeah, maybe.
Yeah. Anyways, I think we'll wrap on that. But before I bust out any more Star Wars quotes, but I appreciate you taking the time to come on, Seth. I think it's interesting. Like look, investing's cool because there's so many places to look for opportunity, right? Like
Yeah.
there's never a point in time that everything sucks. You know,
Oh, there's
like that
an
everything's a
infinite
bad time,
number.
everything's a bad deal, right? It's just times and seasons and cycles and mind the farm accordingly.
Yep. There's an infinite number of decisions you can make any day that can either add or not value.
Yeah.
And
Well, and
that's what
timelines matter
makes,
too.
what was that?
I said timelines always matter too, right? So
Yep.
everyone's got different timelines.
And look, the fact is, if we want to back up for a second, we're talking about largely investing, at least for us, investing in the United States, which has a long history of being very innovative and providing significant value over the long run, right? And so that's where when you mention the stock's not the company is not the stock, we're talking about stocks, but as far as the US, if we're looking as like the aggregate of the companies,
Hmm.
it's going to be great, right? It's just a matter of being a little disciplined around the price that you pay.
The path that you the path the price that you pay to be involved as a participant in the stock of the companies is going to be different than the way that you interact with the economy and interact with the companies themselves, right?
Yep.
So, and both of those things matter to each of our lives. So, anyways, well, appreciate it, Seth. I think we're kind of running out of time, and I want to make sure we're respectful of everyone's time. So we'll hop off. But thanks again, and I'm excited to see you around.